Now we're going to turn into OPEC. We're going to talk about U.S. exports and what's happening abroad. And there's a lot of moving pieces, a lot of things that have happened. So we're going to try to summarize things as best we can, just because OPEC is very much a moving target at this point in time. So one of the things that we want to kick off with is just looking at what are some of the demand revisions. So we're looking at IEA, OPEC, EIA, and you can see what the demand expectations are for 2021, about anywhere from 96.5 to 97.5, and you can see the changes versus last year, 5 to 6 million barrels a day, and then change of just in terms of where some of the revisions. Now, some of the comments have increased in terms of, well, what happens if some of this Asia Pacific slowdowns is a bit stickier, and that's some of the things that we've been talking about, where we see a bit more damage that is coming through in terms of what has happened in Asia, especially as Chinese demand is kind of flat at this point. We're not seeing a huge surge higher. We're not seeing much of a drop either. It's just kind of here, which is below, I think, what the market was expecting, as they've talked about, and there was actually an official filing that they're going to release about 20 million barrels, and it looks like it could go upwards to about 30 million barrels from the SPR, because remember, SPR and commercial is a bit fuzzy in terms of where things are in India and China. And you're starting to see some of those shifts, and we'll talk about some of the declines that we've seen in state-owned enterprise refiners, where we're seeing some of them slow down a bit. There's obviously a lot of weather issues that we'll discuss in segment 1 of the Econ show, which is also going to be a driver to some activity. But when we look at Europe and the U.S., that's where I think you're starting to see some of that capping of demand, and we're actually starting to see some degradation of demand into Europe, with the U.S. maintaining a certain amount of pretty much a steady state as we go through the remainder of summer, or peak demand. So now when we look at this chart, we want to draw your attention to what some of the underlying components are, because this is where the baseline has been taken up. So we have been very adamant, based on our conversations with clients, based on what we're reading, what we're seeing, what we're hearing, that there has been investment in supply throughout the Middle East. They're not going to come out and call it out because there's an ESG push, there's this, there's that. But it doesn't mean that they aren't doing it. And that's what we continue to see. And some of the things that we're seeing in general on the effective production as of May 2022. So you're seeing the baseline get taken up because spare capacity is being shifted higher. So what is the backdrop? So Saudi Arabia is going to increase to up 500,000 barrels a day. Russia's increasing up 500,000 barrels a day. The UAE, this is where they made a deal. So remember, they're at 3.1. They wanted 3.8. We expected 3.4. They agreed at 3.5. So again, pretty much splitting the difference of what they're seeing, because they've now taken their spare capacity to about 4.1 million barrels a day, or total capacity to 4.1 million barrels. Iraq was given an increase of 150,000 barrels a day, and Kuwait was also given an increase of 150,000 barrels a day. This is because they are increasing production. They're increasing their baseload. They're addressing the decline curves, but they're also adding new production on top of that. Some early estimates that we've seen has put potential Saudi capacity over 13 million barrels a day, closer to 14, even 15, depending on how they're going to classify the neutral zone, because the neutral zone is seeing investment as well. So there has been investment. And remember, ESG is taking center stage. NOCs are avoiding it. IOCs are avoiding it because they don't want to get caught in the, oh, well, you're polluting the earth, you're doing this. But there has been investment. There continues to be investment. And we're starting to see that show up by taking some of the capacity in general. So I think it was on Twitter, I thought someone said it very well. Think of OPEC as coal and natural gas, electrical generation, base load. They're taking base load higher. So that means the swing will be less needed, and which is why we were saying in July of 2019, we overran demand for U.S. crude at 13 million barrels a day. Nobody could take down that much U.S. crude. And we initially had said that it should be closer to between 11 and 12. Obviously, COVID helped us reach that number. But that's why we think that there's going to be that steady move up, getting to that 11.6, 11.7 million barrels a day. It's all going to come down to how quickly can we see those frac spread counts come back. So then when we look at some of the setup, so in order to phase out the remaining 5.76 million barrels a day of the original 9.7 million barrels a day of production cuts, the OPEC group has agreed to raise collective output by 400,000 barrels a day for August, and then extend the current 2-year pact beyond the April 2022 expiry. So remember, it's supposed to expire April 2022. They've extended it through the end of the year, but it's going to be at a higher baseline because the baseline being used right now expires with the original agreement, and then the new agreement is going to have a higher baseline, bringing back even more crude a bit faster, which is why we've seen the curve come under pressure in the later months. So while the group aims to fully unwind its original cut by the end of September 2022, the extension would allow for a 3-month window to pause quota increases, again, kind of pushing and opening up the ability to get into December, depending on what happens with U.S. sanctions and Iran, because that could adjust some of those movements. So the UAE agreed that the baselines from which output adjustments are calculated was raised from May 2022 for 5 of the participants talked about above. So the baseline increases accumulate to about 1.63 million barrels a day of baseline output has been taken higher. OPEC Plus will add 3.6 million barrels a day of production to the market between August and April of 2022 if it eases the cuts every month by 400,000. This will leave 2.16 million barrels a day of the original cut to phase out, which would equate to 432,000 barrels a day from May to September if the 3-month pause is not used. So again, also taking that baseline higher. The adjustment is the 5 producers reference production above. So, but there remains levels of uncertainty among some other member countries, with 2 delegates expecting the 1.6 million barrels a day baseline adjustment to push a portion of this volume into the market from May, in addition to the 432,000. This outcome seems less likely. So, this was these summaries came from Argus. I retweeted it. You can find it. I'll retweet it again with this section, just because I thought it was a very good article kind of highlighting where things are in general. And this just shows the sharing the burden. So this is factoring everything that is done. So the new OPEC Plus deal is still favorable for Russia and Saudi, and you could see where the UAE is based on where their additions are. So this is something that could have been agreed upon just to get an agreement through. I expect to see the UAE still continue to say, as we get closer, and if demand continues to recover, we continue to see some normalcy, the UAE is going to want to increase, but we've already seen them export well above their normal. So they could just say, look, we'll keep production here, but we're just going to do whatever we want. We'll agree in terms, but we're going to, I don't want to say cheat, but export, 150 to 200,000 barrels above what production would allot. Now, the other important capacity is Saudi direct crude use, because we continue to see Saudi direct crude use, and really throughout the Middle East, as well as Kuwait and the UAE, has declined. And remember, they've tried to adopt more natural gas. Kuwait just brought on one of their import terminals. So here you can see that they're continuing to use less of their crude to power gen and some of the other capacity. They've also had their own issues with COVID increases, which leads to, again, putting more refined product on the water. Some of that is showing up in the U.S., as we've talked about. But it also means that this is just more crude slated for export. If it's not being consumed locally, we've seen that Saudi's trying to draw down some of their own storage after seeing this huge surge in 15 and 16. This is just again, even though production numbers are down, this is going to keep exports elevated, which is resulting in more crude sitting in floating storage in the Middle East. So now getting into U.S. product and crude product exports. Gasoline had an increase of 119,000 barrels a day, up to 866,000 barrels. That's 327,000 above the 5-year average. That is the one that, again, we're seeing this move, but it's really not gasoline per se. It's more of a blending side of a lot of naphtha, but it's being flagged as such. So that's something to consider to see where the flows should remain into the Europe based on some of the setups that we're seeing, where distillate's going to come under more pressure, especially as the additional capacity comes from Asia, from the Middle East into the Atlantic Basin and getting pulled into Europe. So distillate fuel oil was down 59,000 barrels a day, still 42,000 above the 5-year average, but again, that pressure is coming. Propane was up 115,000 barrels a day. That's 226,000 above the 5-year average. Still staying strong. It'll waffle up and down. There's still a huge amount of demand for LPG, especially U.S. LPG in Asia, not stopping in general. Crude exports, that's, again, it's just funny because it's down 1.56 million barrels a day. So it went from over 4 million to 2.46 million. That's a huge move, and again, speaks to what we've been saying in terms of just we're much closer to 2.8 than we are to 3.2. And this is where we think that now you've had a little bit of this true up, you're going to see some of this remain depressed, especially when you look at spreads in general. But so now let's look at this in pieces. So Europe's crude imports from the U.S. Gulf are set to fall this month from June's 14-month high, again supporting our view that you're going to get a drop in July, and that drop is going to remain through August. 20 tankers carrying about 11.4 million barrels have arrived in Europe so far in July after loading crude, with another 25 tankers holding 16.2 million barrels are expected to arrive by the end of the month. So you're essentially going to see crude go from the U.S. storage into Europe storage. So you're just going to waffle from one to the other. So that's why we always look at some of the different components. And remember, there is a shipping time. So there's going to be a delay as to when it leaves U.S. storage and shows up into Europe storage. So you're just moving deck chairs on the Titanic at this point. So now when we look at WTI-DUBAI spread, you can see that there's been a little bit of strength coming through. But again, Dubai still remains cheap. You're still seeing Asia trying to capture some of these discounts that remain in the Middle East. And even though things remain cheap for Angola, Congo, and Nigeria, you're just not seeing the movements into Asia. You're actually seeing some of those movements come west and coming into the U.S. and European markets. So then when we look at Brent versus Dubai, looking at something similar, you can see still a huge discount, and that's where you're seeing the North Sea now. Because remember, we were saying the West Africa and the North Sea are essentially staring at each other, and who blinks first. We saw West Africa blink first. Now you're starting to see the North Sea knock down some of their pricing, which should start to help adjust some of the cheapness. But again, the Middle East remains one of the key places where we're seeing some of these movements, keeping U.S. exports capped, keeping European exports capped, which is going to be a bit of a problem, especially when we look at floating storage. So now when we look at gasoline exports, here you can see that instead of coming further down to the 5-year average, we actually shifted up just based on some of the timing delays and just where that naphtha demand is. We think it's going to go sideways. So we'll probably get a little bit of a drop down, but still stay at seasonally adjusted all-time highs. So the drop won't be too prevalent. It'll just stay at the top of that cloud. Maybe it falls just within that cloud, but still above, essentially still making a higher low and going, still remaining elevated, going sideways. This is one where we think we're going to continue to move closer to the 5-year average, just because distillate demand and distillate flows are going to have a lot of competition, especially as it comes from the Asian and Middle Eastern markets. Here's where we got that big drop back down to these low points. We just expect to see this these movements in a much tighter fashion, where you're still going to get an increase, but the increase is going to be more measured. Decreases won't be as severe, but you're going to stay between, let's call it 2.5 and 2.8 million, maybe some increases to 3 million depending on timing delays. But this should have been the last catch up. Again, there's always chances that you'll get another, but this is where we think you're going to start to see this now work between and get closer to our average that we've been talking about of that 2.6, 2.8. And you're seeing it now in the 4-week rolling average when we had that huge drop down to 3.2. This we think is going to continue to trend lower and get closer to that 2.8 level over the coming few weeks. Propane, again, staying strong, staying over the 5-year average, not much to say here as we continue to see this being elevated in general. And it's really going to continue to be driven based on the demand that we're seeing out of Asia. Now, when we look at European, here you can see that Europe builds had a big shift higher, up almost 5 million barrels. Again, this is that movement of delay between floating storage to onshore storage. We're seeing some slowdowns in some of that refined product demand. That's going to weigh on flows. You're seeing some of those shifts coming from the U.S. into Europe. So you can just see how sizable of a counter-seasonal build this is, which when you look at the 7-year average, you can see that there's typically a draw that happens from the end of May to the essentially the beginning of September, and you've actually had a pretty big sizable reversal. Now, we expect to see some of that draw back down and closer to that 7-year average, but again, you're seeing that shift from the U.S. into Europe and some of those adjustments because they're just not seeing the demand into the floating market. So you're going to take some of this and put it into onshore storage, keeping this elevated. Now, a lot of movements in the physical market because there's a lot of games being played. So let's try to piece it down and boil it down into specifics. So when we look at Russia Federation, that's one that's going to remain elevated. Norway is up to 1.67 million barrels a day. For August, which when you look at the last several months, they're back to highs. And when we look at Nigeria has taken down August expectations and has already moved some of that into September. So we're already seeing deferrals into September. Angola announced a lower level for September versus August. They're already starting to prepare for some of those slowdowns, and you're starting to see that bleed over. Libya is going to post something over about 1 million barrels a day as everything else remains fairly constant. The issue right now is spreads, differentials, and what we're seeing. So let's break it down piece by piece. So there was some new demand from the Middle East from some of the Chinese buyers, as we were talking about, where they're looking to pick up some of that cheaper Abu Dhabi crudes, especially Murbain. Again, speaking to some of the issues of what the UAE versus KSA is going to have, and KSA is just Kingdom of Saudi Arabia, because SA is South Africa. That's why they throw the K in there. So when we look at some of the differences, some of the deliveries that have already been sought are for September and October deliveries, depending on the company out of China. So we're starting to see those come through, but we're not seeing a big increase. It's a very stable level, and they're looking to try to take advantage of some of these spot tenders just based on the fact that Abu Dhabi crudes still are trading at a pretty steep discount versus Brent and versus West Africa and versus WTI. So offers for September delivery, Johan, were in the range of $1.20 to $1.60. And if you remember that for premium to November ICE Brent, while cargoes to be delivered in October will offer just below $2 premium. And you can see that this is just a continued movement lower on premiums, with Congo fell to a 90-cent premium after being at over $1. So again, you're starting to see the softness into West Africa, and it's really also being driven by the competition between North Sea, as you continue to see them ratchet down to see where can they move these crudes. August delivery of Congo was offered at around 50-cent premium, and that was off of some of the elevated levels. Dahlia, August was offered at around $1.30 premium. So you're seeing some of the shifts in general. Again, all of these are showing some slight declines after what we've seen. And remember, this is going out into not only just September, but October and November, where we're seeing some of the softness. Now, one of the ones that I wanted to highlight the most, because we've been following it the closest, is ESPO. So September delivery of ESPO blend edged down to a $1.30 premium. Offers for August delivery cargoes were stable at about $2. So you're actually seeing some of this softness. So blend premiums continued to slide on weak demand from China's independent refiners. September loading ESPO blend traded at premiums of around $2.50. And now they're actually closer to about $2. And they were initially at about $2.80, $3. So they're actually moving further lower. So they went from $2.80 to $3 down to $2.50. Now we're seeing some additional pressure down to $2, which speaks to some of the issues, because typically when you look at ESPO, that has been fairly strong, and this is actually the lowest it's been in some time, especially when you go back over that time period. So now when we look at Vital, offered 100,000 euros for July 31st, August 4th delivery at $2.40 below dated Brent. It was initially at $2.45, so you're still right within that level. And then when you look, it was initially at $2.35, so you're starting to try to find this level of between negative $2.50 and negative $2.30 and trying to see where the options are. The problem is, as ESPO softens, that will also put a cap and push euros down, keeping some of the levels fairly fixed. And then when we look at what's happened with dated Brent, you can, especially with Brent and what's coming out of the North Sea, you're seeing some of these discounts coming in. So just for an example, Fortes is at $1.05 premium, was initially $1.25, was was previously $1.35. So you're starting to see some of these movements as they walk back. Again, still at a premium, but you're starting to see some of this tightness overall in that time period. So now when we look at Fujairah, so as we were saying, we expected to see builds in light distillates and middle distillates and some draws in heavy. Instead, we did get the builds in light, still small draws in middle, but that's something that we continue to, that we see adjusting. So July 19th, Fujairah reported 21.754 million barrels. And that's a small increase of 13,000 barrels a day, which is still remains lower than the average level of 22.8 that was seen in May and June. And that's where we think we're going to get closer to some of these levels in general, only because stock of light distillates, gasoline and naphtha increased 423,000 barrels a day, up 6.8%. The restocking is primarily attributed to weakening demand in east of Suez market. Again, that we've talked about with emerging markets, Asia, and the dramatic rise of Delta variants, which is what we've been saying with the lockdowns in Southeast Asian nations, putting some of that downward pressure. There's also the holidays in the Middle East, and that's slowed down some of the supply, so we expect some of the supply to come back. Some of that recovering demand in India is starting to top out. It's on the light distillate side, middle distillates still haven't really gotten there. And on the supply side, market participants are waiting for the announcement of China's newly allocated export quotas, because exports were very strong. So in June, what will July look like and how will August? So on the physical front, Indonesia is expected to lower its intake of gasoline for August to around 7 to 8 million barrels, down from the 8 million barrels it had planned to import in July. So you're starting to see, again, that softness, again, speaking to the issues with demand in general. UAE was seeking a total of some gasoline, but that has since ebbed in general. Now, stock of middle distillates dropped to 359,000 barrels, or 9.6% week on week, recording the lowest level since April 26th. The gas oil fundamentals in east of Suez turned a bit firmer. That's where we think that you're going to start to see some of that softness driven based on the Singapore crack, because the Singapore cracks are under significant pressure just due to demand issues. So they're trying to manage their storage. So bullish on the supply side caused by the tightened Chinese gas oil exports in July seems outweighing the bearish of the demand side. So it's going to be supply versus demand. Demand has been bearish, but supply has come down. So the question is going to be, how bad is demand versus how bad is supply? And That's typically not a positive for oil demand in general. When supply is coming down and demand is coming down, and you're hopeful one is going to outdo the other. Again, speaking to some of the issues in general. And then when we look at stocks of heavy resid rose for 49,000 barrels, it was just 0.4%. And it's just the shift in terms of what we're seeing on shipping, where you're getting a little bit of a lull, should start to see an increase, which will bring down heavy disti, where we continue to see builds of light and middle. Crude oil on water has come back within the 5-year onto the 5-year average. Again, starting to see that spike. We expect to see this continue to increase as it goes from floating storage into movement. You're starting to see some of those shifts as Asia is picking up some of those additional cargoes, but it's still going to be well within that seasonal norm as we go forward. With crude oil in transit being the biggest driver, now just above the 5-year average. We expect to see this drift higher as some goes from floating storage into crude oil in transit, and then it's going to convert back into floating storage, just given timing delays on getting things through and what that demand situation looks like once it arrives. So here you can see with that floating storage had a small decline, still above the low point that was reached at the beginning of June. And this is where we continue to see just floating storage going sideways, creating kind of that chevron pattern as we go forward. But if you look at where we were in 2017, where we were in 2016, where we were in 2020, you typically see draws. You typically see this drawing down, and we just don't see it drawing down, which is a net, going to put some pressure on where some of those prices will go over time. So then when we look at at Europe, you can see Europe gasoline had a draw of 102,000 tons, bringing us to about 892,000. That is where we're seeing a shift. We're going to start to see those build just because exports are slowing. The Rhine had some issues with barges and flooding, and when you look at just what's happened in Europe. And it's important to highlight the issues on European floods on demand. So we've talked about some of the issues on just European COVID increases, but you're also seeing flood impacts as well, which is going to continue to drive. And then we expect to see gas oil inventories increase, where naphtha, we also expect to see an increase as things show up from the U.S. into Europe. European imports of refined oil products from the Middle East climb to the highest in 9 months, with a surge in shipments from Kuwait and the UAE. Expected fuel arrivals in July have jumped to about 1.99 million tons, so far the most since October. That includes 21 tankers that have arrived with about 1.4 million tons, 10 tankers right now en route. In addition, 6 tankers have been booked and are being loaded with 460,000 tons, which compares with 17 in June. So you're seeing that walk up again. That's going to keep the Atlantic Basin fairly elevated. And this is where now gasoline is at the 15-year level. And this is when you look at that level, typically we start to see an increase in builds. We expect to see the same happen, and we'll know more tomorrow. Where fuel oil has stopped going down, this is the recracking side. We expect to see this drift to the sideways and even start to drift up a bit as you start to see refiners adjusting down some of their refinery runs, which again is going to cap some of that drawdown. When we look at Singapore, you can see that we were expecting about 49.5 to 50 million barrels in storage. It went from 48.7 to 49.1, pretty close there. And when we look at that seasonal storage on total products, it's going to be again that chevron pattern, up and down, going sideways, not making new highs, not really drawing down, just because we continue to see headwinds on supply and more importantly on demand. And then when we look at middle distillate, this is going to be the driver higher. So some of this has been released into Europe and into the Atlantic Basin. This is going to start to increase again. And then speaking more to the problems that remain in Southeast Asia, light distillates we think is going to continue to go up and really challenge some of those near-term seasonal highs, just given the problems with demand. When we look at Brent time spreads, you can see that they've come down significantly from off $1. Bouncing here, so they're still high, especially when you look at 2021, but you're starting to see some normalization and some pressure come into that market in general. And then speaking of December versus December, they're bouncing off the lows, but you can see that they're off highs, still elevated for 2021. And this is where the question is going to be, what does next December look like based on OPEC bringing back new supply? Where is demand? How much of that starts to normalize? And that's where we're going to start to see some headwinds in terms of what the spread looks like. Not to say it's going to go negative, but it's just going to, I think, normalize a bit more as some of the OPEC news gets priced into the market in general. Singapore margins are coming back down. They had some of that increase. Now you're starting to see this bifurcation. Across the board, you can see that hydrocracking still is net positive, but everything else is negative, and you're starting to see that pull everything down. And when we look at hydrocracking, it's within the cloud, but still at seasonally adjusted, essentially near all-time lows. Europe is seeing something similar, a little bit of a recovery in the bottom end of that stack. When you look at, I should say the top end of the stack, when you look at topping and some of the other pieces, but it's still, you're still going to struggle. And that's why Urals went from essentially almost $3 discount to about a $2.40 discount. And that has helped support some of that through. But as Libya continues to compete, there's more European cargo, more U.S. cargoes coming to Europe. That, again, is going to keep some of that capped. And it's also not ubiquitous between the two. So you're seeing Mediterranean still remain under pressure, wide spreads, which is why we continue to see pressures within the Asian markets. China's supertanker crude imports still remaining elevated. It's going to continue to drift higher based on what we've seen. And you're going to see this, again, come back above that 4-year rolling average. But when we look at rates in general, so Shandong independent crude rates, refinery run rates are at 74%, up a bit. But when we look at state-run refiners, they've actually gotten hit pretty hard. Like when you look across the board, they're actually down. And this is a mixture of flooding. This is a mixture of problems on the demand side. But the SOEs continue to be under pressure when you look at utilization rates. And it's a demand issue. It is just what is happening in general within the country, which is why we see some of those pressures on demand. China crude oil total imports for June, you can see that they were flat. They were actually down and coming to the lowest level that they've been in 2021 and right around those 2019 levels. So then when we look at exports, gasoline exports, even though they were down, they're still seasonally adjusted at all-time highs. This we expect to continue to come down for July as there's less exports. But then when we look at diesel, you can see that seasonally adjusted, again, all-time high. This is something that's going to come back down, but we still expect it to be at all-time highs where it's not going to come back within that cloud, but still remain at elevated levels. Asian floating storage came down a bit. Again, Chevron pattern to the sideways where we think that it's going to remain elevated. North Sea came down a bit just based on what we've been talking about. This is going to turn back up. Still not come back to the 5-year average, but still essentially go sideways, creating, again, kind of that Chevron pattern. As the 5-year average becomes an easier comp, that's where it's going to come back to and get back to that seasonal norm. West Africa, seasonally adjusted, all-time highs, 2021, all-time highs. Again, this is where we see that elevated level, which is why we're seeing those deferrals, we're seeing those discounts. Even though OSPs are going up, actual trading numbers are coming down. This is where we see some of those additional headwinds. Middle East oil floating storage. Again, Dubai is cheap because you're seeing this creep up. So if you look at 2017 versus 2016, you want to look at 2020. So 2020 is still below, and you're seeing this slow ramp up. Iraq had trouble clearing in June. They're still having trouble clearing in July. Saudi is increasing in August. All of these countries are increasing in August, and we're seeing this slowdown in exports in June. you're seeing this some issues in July, and there's new crude coming on the market in August. Again, speaking to some of the problems that we continue to see, resulting in some of those increases in floating storage. As U.S. crude show up in Europe, this is going to push some of the floating storage higher, still stay below the 5-year average, but again, shifting up. As crude stocks in Shandong remain elevated at near all-time highs, based on their new allocations, they're still going to remain with crude oil in storage at near all-time highs. And fuel oil in storage has reached a 2021 high. You can see that we're still well off of 2014. But again, that's also a reclassification of fuel oil and the way things were being moved. So this is, again, concerning for where some of these operations are going to go over the coming months. And we expect to see some of this fuel oil come into the market in general. Prices were cut for bitumen, which brought asphalt prices down in China. That's going to adjust some of the movements, but again, still a lot of elevated levels. So I know we covered a lot. We touched on OPEC just to kind of bring in all the pieces together. If you have any questions, please let us know. We'd love to hear from you. And again, your support is appreciated. So I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.